Come to IAS 32, Financial Instrument Presentation. How many standards are there with respect to financial instrument? 3. 3 standards are dedicated for financial instrument. One is IAS 32, which is financial instrument presentation. It is similar to INDAS 32, same name, financial instrument presentation. Then there is IFRS 7, financial instrument disclosure, which is similar to INDAS 107, and IFRS 9, which is same as INDAS 109, financial instrument. This is a very important instrument both for exam purpose and also after your qualification, because now many companies use large number of financial instruments. How to do the accounting of financial instrument is a challenge, because it requires a lot of understanding of finance. For example, the moment we start, I'll give you a question on accounting of call option, and then you should know what is a call option, or accounting of put option, interest rate swap, okay, future and options. So those things you should know, plus some calculations like IRR would be required, present value would be required. So I'm assuming you are familiar with how to calculate IRR or present values, okay, and of course you need to know the accounting also. So CA's role has become very complicated, because he should know accounts also, finance also, maths also, stats also, and other things. So IFRS and INDAS have 3 comprehensive standards on financial instrument. These standards have got revised over a period of time. Earlier version was different. In USA, there was some economic crisis, as a result of which the International Accounting Standard Board, US GAAP board, they sat down and they have come out with this comprehensive standard on financial instrument, because a lot of risk is involved when an entity invests in financial instrument. Okay. This standard, first standard that we are going to cover today, is going to basically help us in understanding the presentation of liability and equity. Not much of accounting is involved today, but only an instrument has to be either classified as liability or equity. Some discussion about financial asset also we will have. Okay. This standard gives a lot of importance to substance over form. So in form the instrument may appear as 1, in substance it may be 2. For example, convertible bond. In form it is one instrument, that is bond or debenture, but in substance there are 2 instruments. Some portion of it is bond, that is a liability, and some portion of it is equity. So what we have to do? We have to split it into liability and equity. Is it right? The liability portion will be accounted as per the guidance on financial liability, and the equity portion will be accounted as per the guidance given for equity. Or say for example, preference share capital. Is it a liability or equity? In form it is a share, because Companies Act says there are 2 types of share, equity and preference share. But do we do the accounting also like that way? In this chapter you will learn preference share is actually a liability, especially in a country like India where it is a redeemable instrument. You can't issue irredeemable preference share. So in form it is a share, in substance it is a liability. So dividend paid on preference share, which is a liability, what will be the treatment? Expense or appropriation? Expense. If the instrument is a liability, then dividend paid will be treated like expense rather than appropriation of profit, which you have been learning since ages. Okay. Now, how many types of financial assets are there? Do you have any idea? There are 3 types of financial assets. So I want answer from some of you. Financial assets are of 3 types. Financial asset carried at amortized cost. Financial asset which are measured at fair value through P&L account. And financial asset which are measured at fair value through other comprehensive income. Seems little complicated at the beginning. Whether this instrument will go as FVTPL, FVTOCI or amortized cost. So that also we will learn, right? Then how many types of financial liabilities are there? Come on, 2 types. Generally 2 types for accounting purpose. One is financial liabilities carried at amortized cost and financial liabilities carried at fair value through profit and loss account. So this will be 2 broad categories of financial liabilities, right? Sometimes a substantial amount of judgment will be required to determine the correct classification. Sometimes judgment may be required whether this instrument is equity or a liability. Like for example, in case of irredeemable preference share, is it equity or liability? We'll answer later, but you can keep thinking whether irredeemable preference share is equity or liability. So financial instrument will be classified based on substance of the instrument rather than the form. All financial instrument, once you are proved that it is a financial instrument, it will be valued at fair value on the day 1, and then subsequent accounting will depend on the classification. So in case if it is a financial asset, there are 3 classifications. Subsequent accounting will be accordingly done. Financial asset can be amortized cost, FVTOCI means fair value through other comprehensive income, and FVTPL, that is fair value through profit and loss. What is the difference between the two when both are being measured at fair value? Here the fair value change will be routed through other comprehensive income. That is the second part of the financial statement, profit and loss. And here the change in the fair value will be routed through profit and loss account. Liabilities will be of 2 types. FVTPL, same reason, same classification. The change in fair value will be routed through profit and loss account. And the second category, which is amortized cost. So there are 3 standards dealing with financial instruments. One is called IAS 32. In India, there is a counterpart called INDAS 32, Financial Instrument Presentation, which is my first topic today. Financial instrument presentation means here basically we are going to learn how to classify a financial instrument into equity and liability. Whether the payment made on a financial instrument is an expense or an appropriation. Can we net off a financial asset against a financial liability? This we will cover in this standard. This standard will not discuss much about the recognition, measurement, principle, etc. For that we have another standard, IFRS 9, which is INDAS 109. This INDAS 109 gives a detailed guidance on recognition, measurement, derecognition, classification, impairment, and hedge accounting, and many things more. What about the disclosure aspect? A full standard is devoted to disclosure requirement. That is IFRS 7, and its Indian counterpart is INDAS 107. What about the fair value measurement? Does the standard talk about how to do fair valuation? Absolutely no. Fair valuation will be done as per another standard, which is IFRS 13, and its Indian version is INDAS 113. Just add 100 to that. If the prefix is IFRS, the Indian version is INDAS 113. Right? So let us start. Financial instrument INDAS 32 or IAS 32 talks only about presentation part. Not much of accounting is involved today, but yes, a lot of calculation will be involved, so be ready. Okay. Objective of IAS 32. First is classification. So our first half an hour will be spent on understanding the classification of financial instrument into financial asset, financial liability, and equity instrument. Because your further accounting in IFRS 9 will depend on the classification. Then how to recognize interest, dividend, gain or loss on financial instrument. And we will also discuss in the last part whether we can set off or offset a financial asset against a financial liability. What do you mean by offset? Suppose I have a debtor also and I have a creditor also. A debtor is a financial asset, a creditor is a financial liability. Can I show a net amount? No? Yes? Depends. So on what are the grounds on which we can set them off, and when we cannot set them off, that we will cover under this standard. Suppose you have a bank overdraft and a saving account. Current account, saving account is not right. Current account and an overdraft account. Can we set off? It can be yes also, it can be no also. For that, there are some conditions given in this standard. What is financial instrument? Is this mic a financial instrument? No. Prove why it is not. Is this fan a financial instrument? Your auditing book, is it a financial instrument? So there are certain categories of assets or liabilities which can only be treated as financial instrument. Okay. So in the balance sheet or statement of financial position, which of the item will be treated as financial instrument? If it is a financial instrument, we are going to continue further. If it is not a financial statement, we cannot continue further right now. So what is a financial instrument? Is any contract. Financial instrument must be a contract. So if I have to pay income tax to the government, can it be called as a financial instrument? No, because there is no contract between the entity and the government. It is my statutory obligation. Is it right? So it has to be a contractual obligation that give rise to financial asset to one enterprise. And at the same time, it should give rise to either financial liability or equity instrument of another enterprise. So for one party, it should be a financial asset. And for the other party, it should be either a financial liability or an equity instrument. If yes, it is a financial instrument. So for example, debenture issued by a company. There are two parties involved now. The company which has issued the debenture and the investor who has invested in that debenture. For the investor, it is a financial asset. For the company, it's a financial liability. A company has issued equity share. For the investor, it is a financial asset. For the issuing company, it is an equity instrument. It is an equity instrument. Okay. Or debtor and creditor. For me, the other party is a debtor. For him, I am the creditor. Right? So for me, he is a financial asset. For him, I am the financial liability. Bills receivable, bills payable. Financial asset, financial liability. Loan given, loan taken. Financial asset, financial liability. Investment in preference share and preference share issued by a company. For one party it is a financial asset, for other party it will be either liability or equity. That is what we will learn, when is a preferential liability and when it is a equity. Okay, so some of the examples of financial instruments are trade receivables and payable, debtor creditor, bills receivable, bills payable, loan given, loan taken, overdraft, issued debt means debenture. So debenture, bond, loan, whatever is the name, is a financial instrument. Equity share, preference share, investment in securities like shares and bond. Up to this it was simple. Then it becomes little complicated below. Derivatives are also financial instrument. Derivatives are also financial instrument because for one party it is a financial asset, for the other party it is a financial liability or equity. Financial liability or equity. Example of derivative: forward, future, option, swap, and many more. Okay. Have you studied this concept of forward, future, option, and swap? Good. If you have not studied, very good. Now, there are some contracts which may require you to buy or sell non-financial asset, but their features are such that they are like derivatives. Like for example, a company says, I will buy 100 kgs of wheat, but my intention is not to buy wheat. My intention is to do the net settlement in that wheat. I believe that price of the wheat will go up. So I tell the other party, don't deliver me the wheat. I will not pay you the gross amount. Only the differential amount we are going to settle. That contract will also get covered here like a derivative contract. However, if there is a contract to actually take the physical delivery of the wheat for my business purpose, then that contract will not come under the standard. Then it becomes an executory contract, not applicable. But if it is going to be settled in net, it becomes a derivative, and then this standard will take care of that kind of contract. Financial instrument can be divided into, for our general understanding, this is not given in the standard, 3 types. Primary instrument means basic instrument, original instrument, like for example cash deposited in bank, FD, bonds, loan, receivables, payable, borrowing, and finance lease receivables. First accounting of finance lease will be done under standard on leases. After that, the lease receivable becomes a financial instrument, and then some portion of that lease receivable will be accounted as per this standard. Like for example, if there is a possibility of bad debt, so that bad debt calculation is not done under that lease accounting. That will be done under this accounting or equity instrument. The second type of financial instrument is derivative instrument. Derivative instruments are those financial instruments which derive their value from another instrument. On their own, they are meaningless. They are always linked to some other assets, some other underlying. That underlying can be currency. The underlying can be a financial instrument like equity share, debenture. It can be a commodity like gold, copper, or it can be anything like weather also. Is it right? Some of the common type of derivative that we use and which are traded on the exchanges also are future, options, swaps, and across the counter you can take forward, guarantees, letter of credit. And there are third type of financial instrument, merge the two, mix the two, becomes a hybrid instrument. Like for example, convertible debt. How is a convertible debt a hybrid instrument? It is a debt plus an option to convert into shares. So only debt is a primary instrument. Only option to convert into share is a derivative instrument. But the same instrument has both the feature. It is a debt also and it also has a feature of conversion. So that kind of instrument becomes hybrid instrument. Another type, callable bond. Callable bond means a bond with call option. Puttable bond, a bond with put option. Is it right? Extendable bond, a bond with an option to extend the maturity of the bond. Right? So those are hybrid instruments because they have something else over and above a primary instrument embedded in that. Now, what is a financial asset? First, we have seen the meaning of financial instrument is a contract that give rise to financial asset of one enterprise and financial liability or equity to another enterprise. Means I need to know three more terms to understand the meaning of financial instrument. Which are the three other terms I need to know? Financial asset, financial liability, and equity. Because the definition of financial instrument uses three terms: asset, liability, and equity. So what is a financial asset? So my question was, is this mic or this fan or this light or this camera or this projector, can it be called as a financial asset? Read the definition, then answer. Okay. It can be. Let us see. So financial asset is any asset. What is an asset? It has four features. Asset is a resource controlled by the entity, arising out of past event, and from which future economic benefit will flow to the enterprise. So first these four features, we assume that is always satisfied. And then a financial asset is an asset that is cash. So cash is by definition a financial asset. Cash means cash at bank also. Cash deposited in bank also. Gold kept in bank locker, is it a financial asset? No. Gold kept in a bank is not a financial asset. FD is a financial asset. Or it is an equity instrument of another entity. So this is by definition financial asset if it is an equity instrument. But what is equity instrument, we will see again after some time. Up to this was simple. Or a contractual right. Contractual right, again I am emphasizing on this word contractual right. If it is a legal right, not applicable. Contractual right to receive cash. An example of any financial asset which has a contractual right to receive cash, I have written two examples here. Example, investment in bond. When you invest in a bond, normally you have two rights: to receive interest and the redemption value. Is it right? Interest and redemption value normally. So therefore investment in bond gives a contractual right to receive the periodic interest and the redemption value. Or simple example is your debtor. A debtor bills receivable are contractual right to receive cash. When you sell goods on credit, there is a contract between the seller and the buyer that you will pay me the cash after 3 months. So it's a contractual right. Sale of good is a contract between the seller and the buyer. Or another financial asset. The definition of financial asset itself uses the term financial asset, or another financial asset from another entity. Sometimes you may not receive cash, but it can be settled in the form of another financial asset. For example, investment in convertible debenture. Now you may not receive any cash here, but you may receive equity share from other entity, and for you then equity, investment in equity instrument becomes a financial asset. Okay. Now some questions on this point. Is prepaid expense a financial asset? Prepaid expense financial asset? The answer is no. Why? Because there is no contractual right to receive cash. There is a contractual right to receive services. there is a contractual right to receive services. So sometimes we pay insurance premium for full year, 12 months, but it is paid somewhere around say 1st July. So it goes up to 30th June of the next year. So for 3 months it is a prepaid. Insurance company will provide me service for 3 more months. Rent paid in advance for 6 months. You are going to get the services. Okay. Advance given to supplier for goods. Advance given to supplier for goods. Only up to this read and tell me, is it a financial asset? The answer is no. What you will get in return? Contractual right to receive goods, not cash or another financial asset. The definition will become more complicated as we go one line below. A contractual right to exchange financial asset or financial liability with another entity under conditions that are potentially favorable to the entity. For example, derivatives like call, put, forward, future, etc. 2 examples we will discuss. If required, we'll discuss more. So first example is a call option. What is a call option? A call option is an option to buy or not to buy an underlying asset at the exercise price. Yes or no? Was it correct? Right to buy but not the obligation to buy. An option to buy means right to buy but not the obligation to buy. A specified quantity of an underlying asset at a specified price on a specified date in future, but the price is already locked in advance. When is a call option exercised? It's a right to buy. So when would the person holding the call option exercise his right? When the market price is more than exercise price. Okay, so this much knowledge is enough. Call option means right to buy but not the obligation to buy, like your exam form fees. Okay, right to appear but not the obligation to appear. So you're actually paying a premium to the institute. Okay, call is exercised when market price is more than the exercise price. Only then it is profitable to the holder of the option. Call option has 2 parties. One is called call holder and the other is called call writer. Call holder has the right but not the obligation. Call writer has the obligation but not the right. Okay. Call holder pays premium to call writer. All the risk is transferred to call writer. All the risks are transferred to call writer. Why will call writer give you such an option that if the price goes up, you can buy from me at the exercise price. If the price falls, you are free not to buy. Who is at a serious disadvantage situation? Writer. So who has to pay the premium to whom? Call holder will pay premium to call writer. Is it right? Options are like insurance. Options are like insurance if the objective is to hedge. That by paying a premium, now you can be sure I am going to buy this underlying at this price even if the price goes up. After this understanding of call option, X Limited holds a call option to purchase the share of a company for ₹50 per share. This is oversimplified example. When we'll solve the problem, it will get more and more complicated. Right now, just for the beginners, you have a right to buy the share at ₹50 per share, and on the reporting date, the market price is 60. You are not exercising right now, but you know that the market price is 60. Is it profitable to you to exercise? Yes. Has the contract become favorable to the holder? Has the contract become favorable to the holder? How it has become favorable to the holder? He pays 50 rupees. He gets a financial asset worth 60 rupees. So in the books of X Limited, who is the holder here, this call option will become a financial asset. And in the books of the writer, whose name we have not written, it will become a liability, because then he is at a loss making situation. So call option in this example becomes a financial asset for the holder and becomes financial liability for the writer. Okay. Another example is put option. Put option works reverse way. When you are investing in put option, what is your view about the market price in future? Market price will fall. Call option holder expect price will go up. Put option holder expect price will come down. Is it right? So put option means right but not the obligation to sell. Right but not the obligation to sell. When is put option exercised? When market price is equal to, greater than, less than exercise price. Put is exercised because you have a right to sell at a higher price. Market price is lower, but still you can sell it at the higher price. Okay. Next three lines I am not going to write. There are two parties, put holder, put writer. Put holder has a right to sell, but not the obligation to sell. Put writer has an obligation to buy. Right to sell, obligation to buy, but not the right to buy. If the price goes up, he can't sell the other party, I want to buy. No, you can't. You're a writer. Put option holder pays premium to put option writer. Put option holder pays premium to put option writer. Is it right? After this understanding, now read this example and tell me whether this contract has become a financial asset for X Limited or not. X Limited holds a put option. Means X Limited is a holder. Right to sell, but not the obligation to sell. X Limited holds a put option to purchase the share of the company. Sale. To sell the shares of a company for rupees 50 per share when market price is 40. Is the option exercisable? Technically we will say, is it the option in the money for X Limited? Yes, in the money in case of put option means market price is below the exercise price. We'll not go into that kind of complication. Simply, you have a right to sell at 50 rupees. Market price is 40. So you'll be happy to exercise your right and sell it at 50 rupees. Is it right? Is the contract favorable to X Limited? Yes. You are going to sell an asset worth 40 rupees, but you are going to receive 50 rupees. You have a right to sell at 50 rupees. So you are going to make 10 rupees profit here. Okay. Simple example. So this becomes a derivative financial asset. Derivative financial asset. X Limited will show it as a derivative financial asset. What about Y Limited, the other party? For him it becomes a financial liability. Okay. What about forward and future contract? Some quick discussion on forward and future. Forward and future contract is a right as well as obligation. Right as well as obligation for one party to buy or to sell at contractual price. This is called forward or future. Future is traded on the exchange, forward is traded over the counter. Okay. So after the class, you can come to my office and say, I want to purchase share of this company at this price. We agree, it is a forward. You can go to the National Stock Exchange, same transaction you can enter, it becomes a future contract. But the basic objective is same. Okay, to buy or sell at a predetermined price. Now in this contract, there are two parties. One who has committed to buy and one who has committed to sell. So we will call them buyer and seller simply. The buyer has a right to buy and obligation to buy at the contractual price, and the seller has a right to sell and the obligation to sell at the contractual price. That makes future different from option. Who will pay premium to whom? Nobody. Buyer will say, give me premium. Seller will say, why? I am also taking the risk. Seller says, you give me premium. Buyer says, why I'll pay you premium? I am also exposed to the risk. So nobody pays the premium here. Don't bother. Now, if suppose they have agreed at 1,000 rupees for a share and share price goes up. Share price goes up on the reporting date. It is more than 1,000 rupees now. So who is having a potential gain here? Buyer. And who is having a potential loss here? Seller. So for the buyer, this forward or future contract will become a derivative financial asset. And for the seller, this will become a derivative financial liability. Is it right? Swap I am not discussing right now. Let us first deal with simple things because we have to continue for a long time. Now, we have covered financial asset up to this: cash, equity instrument, contractual right to receive cash or another financial asset, exchange under potentially favorable condition. Or there is one more line which is getting more and more complicated. A contract, again, repetition, contract that will or may be settled. Will be settled is okay. It has to be settled. It may be settled also. May or may not. In entity's own equity instrument. So such contracts which can be settled in entity's own equity instrument. Like a call option on your own equity share. Possible? A forward or a future contract on your own equity share. That if this happens, I'll purchase or I will sell my own equity share. And this contract can be a non-derivative contract or this contract can be a derivative contract. In case of non-derivative contract, for which the entity is or may be obliged to receive a variable number of entities' own equity instrument. So you have a debtor. Debtor is a non-derivative item. He says, I will make the payment in the form of your own equity share. Debtor will pay by giving you your own equity shares. Then this will become a financial asset, but the number of equity shares should be variable. Number of equity shares should be variable. Or it can be a derivative, like as I said, call option on own equity share. Or call option means a right to buy your own equity share, which may be settled other than by exchange of a fixed amount of cash or another financial asset for a fixed number of entities' own equity instrument. So it will be settled but not by a fixed amount of cash. So again, here the amount of cash to be paid is variable. Okay. Fixed for fixed does not qualify as financial asset or a financial liability. They are called equity instrument. Fixed for fixed. That means the contract give rise to a risk to the holder of the instrument. Okay. But if any of the two component is variable or both are variable, means either the cash to be paid is fixed and the number of share to be received is variable, or the cash to be paid is variable and the number of share to be received is fixed, or cash and number of share both are variable, then it will be either financial asset or a financial liability. Okay. This is a part of the definition, but practically such contracts you will not come across in day-to-day life, but still it is a part of our discussion. So this is a summary of what we have done so far. A financial asset can be cash, equity instrument, contractual right to receive cash or another financial asset, a contractual right to exchange financial asset or financial liability under potentially favorable condition, and it can be a contract that will or may be settled in entity's own equity instrument, and this contract can be a derivative contract or it can be a non-derivative contract. In both these cases you have to see one of the two has to be variable. Okay, that is either the cash to be received is variable or the number of share to be received is variable, or both are variable. If both are fixed, then it is not under this financial asset. Examples once again summarize: investment in equity, investment in debt, trade receivable, cash, loan, derivative, financial asset. Now I am going to the previous slide. This is the definition of financial asset. Now answer whether this mic is a financial asset or not. That was my question to begin with. No, it doesn't fit into any of these conditions. It is not cash. It is not equity instrument. It is not a contractual right to receive cash or another financial asset. It is not a contractual right to exchange financial asset or liability under potentially favorable condition. And it is not a derivative or a non-derivative contract to receive entity's own equity instrument. Fan, same reason. Okay. So property, plant and equipment, all items of PPE are not financial asset. They are asset, but they are not financial asset. Okay. What about advance tax paid? Are you going to get the cash back? What about the advance GST paid? Will the government refund you that cash? Is it a contractual right? What about stipend received in advance? Liability. Stipend paid in advance. Is it a financial asset to your boss? Stipend paid in advance? No, you are going to give the services in return next month. So if you look around you, you will be able to understand which item is financial asset and which is not. Then my question was, is gold deposited in a bank locker financial asset? The answer is no. It doesn't fit into any of the five. But is the bank deposit or fixed deposit in a bank a financial asset? Yes, because you have a contractual right to receive the interest and the principal amount. Is inventory a financial asset? Again, the answer is no, because it does not fit into any of the five conditions that they have given. What is a financial liability? Opposite of financial asset. A financial liability is any liability that is a contractual obligation. If it is not a contractual obligation, then it is not a financial liability. There are so many liabilities in the balance sheet, but they are not financial liability. For example, provision for income tax. Simple example. Is it a financial liability? It's a legal or statutory liability. Or provision for your goods and service tax payable. Legal liability. It's not contractual. It's a statutory liability. contractual obligation to deliver cash or another financial asset to another entity. Now the question is whether provision for warranty, when I sell the goods and I give warranty, is it a financial liability? Is it obligation to deliver cash or another financial asset? No. If the product has got some manufacturing problem, the company would replace it, repair it, rectify it. So it does not deliver cash or another financial asset. Okay. But suppose there is a creditor. Is creditor a financial liability? Yes. There is a contractual obligation to pay cash. You give me the goods, I will pay you the cash. Is yes. Bills payable. Yes. Loan taken. Yes. Obligation to pay interest and principal. Debenture issued. Debenture issued. Yes. There is an obligation to pay interest and principal. Even the perpetual instruments like perpetual debt, perpetual preference share are also financial liability because you have to continuously pay the interest. Of course, we will see some condition when they are not a liability, but generally they would be, because every year, even if it is a perpetual debt, you have to pay the interest. What about zero coupon bond? Is it a financial liability? Yes. You don't have an obligation to pay interest, but you have an obligation to repay the principal amount. What about convertible debenture? Now, if suppose you have to pay interest for 5 years and then it is going to be converted, some portion of it is a financial liability because that interest part is your contractual obligation to deliver cash. Okay. Or exchange financial asset or financial liability with another entity under conditions that are potentially unfavorable to the entity. Repeat the same example. There was an example of call option. X Limited is holder, Y Limited is writer, exercise price is 50 and market price is 60 rupees. So call option is favorable to holder here. So for him, it is a financial asset and for him, it is a financial liability. Okay. Repeat that example of put option. X Limited was the holder, Y Limited was writer, the exercise price was 50, market price was 40. It becomes favorable to X Limited, financial asset. It becomes unfavorable to Y Limited, financial liability. Third example I had given was a future and a forward contract. Suppose there is a future contract. Instead of put option, future. Okay. X is buyer, Y is seller of a forward or a future contract. Market price is more than 1000 rupees and the contracted price is 1000 rupees. Market price goes up. For X Limited, the buyer, it is a financial asset, and for Y Limited, the seller, it becomes a financial liability. These are simple examples. Any such contract which becomes favorable to one party and unfavorable to another party would become a financial asset and a financial liability. Up to this also it was simple. Something more now. A contract that will or may be settled in entity's own equity instrument. Will or may be settled in entity's own instrument. and is a non-derivative. The contract is a non-derivative. Example I will discuss just below that. For which the entity is or may be obliged to deliver a variable number of entities own equity instrument. So underline variable number of entities own equity instrument. A non-derivative contract where the entity may be obliged to deliver variable number of own equity instrument. Some 3 examples I have mentioned here how this contract is a financial liability. A debt instrument of $10,000 is to be repaid in 3 years by delivering as many equity shares as are equal to a value of $11,500. Now they can ask you a question in the exam. Given below are the 3 contracts. Identify financial liability. Which of the 3 following contracts are financial liability? So you have to now see, you are going to deliver equity shares. To settle this liability or settle this amount, you are going to deliver equity share equal to value of $11,500. Does it involve variable number of share? Does it involve variable number of share? Because you are going to pay 11,500. But how many equity share you are going to issue will depend on the price of equity share. If the price of the equity share is $100, you are going to issue 105. Yes or no? Yes. If the price of the equity is $10 only, then you will pay 1150 share. So what the other party is getting? He is just getting something worth 11,500. It is like you have taken a loan of 10,000 and you are paying him 11,500. Possibly the difference represent the interest. Instead of paying in cash, you are paying in the form of your own company's equity share. So you are using your own company equity share merely as a currency. It is used as a currency. The other party is not exposed to the risk which an equity holder is exposed to. Are you exposed to equity risk? No. Why? You are getting shares of 11,500. If I would have said I will give you 100 shares to settle your liability and a market price is 20 rupees only, $20. So you'll get only 2,000 worth share. If the market price is $10,000, you'll get shares worth $1 lakh. So you are getting like an equity, you are getting the benefit or you are exposed to the risk. Here the counterpart is not exposed to the risk. He is getting something worth 11,500 only. If the price is less, he gets more share. If the price is more, he gets less shares. So you are just instead of paying cash, you are settling in the form of your own equity, and therefore the standard says it is a liability because the counterparty is not exposed to the risk which an equity holder is exposed to. If it was fixed to fixed, it would have become equity. How? Again I repeat, suppose you don't understand in the first time. 100 share I am going to issue against your $10,000 that you have given me as a loan. Now the other party is exposed to the risk. After 3 years, if the price of the share is $10 only, he'll get only 100 into $10,000, whereas he had invested in me 10,000. But if the price is $5,000 per share, he'll get 5,000 into 100, $5 lakh worth share. So he's going to get that benefit. So who is exposed to such risk? The owner or the lender? Lender. Owner. Owner is exposed to such price fluctuation. Lender gets a fixed amount. Is it right? So this is a liability. Same reason, point number 2, contract to deliver as many of entities own equity instrument as are equal to rupees 100. How many equity share will be issued? total value of equity share will be 100 rupees. Market price is 10 rupees, 10 share will be issued. Market price is 50 rupees, 2 share will be issued. Or a contract to deliver as many of entity's own equity instrument as are equal to value of 100 grams of gold. So here there is a double variability actually. First of all, you have to find out what is the value of 100 grams of gold. That will vary, and to settle that much amount, you have to pay equity share, and that will depend on value of equity shares. So if the gold 100 gram gold is worth 3 lakh rupees and market price of share is 300 rupees, you have to issue 1000 share. If 100 gram of gold is worth 3,50,000, you have to issue more share, like this. So variable number of shares are being issued. This kind of question can come only for a theory question of 2 to 4 marks. Okay. Or they can ask you some simple question. Identify out of the following contractual obligations, which of them would be financial liability. Next is the last line of this definition. A derivative that will or may be settled. That previous one was non-derivative. Other than by exchange of a fixed amount of cash or another financial asset for a fixed number of entities' own equity instrument. Now here we are going to pay or settle by paying a variable amount of cash or a variable amount of another financial asset for a fixed number of entities' own equity instrument. So here the amount to be paid is variable against a fixed number of equity share. Previous example was amount to be or the number of equity share to be issued was variable. Here the amount of cash to be paid is variable. Then there is a reason also why variable, whenever there is a variability involved either in amount or in number of share, it is a liability. If the settlement of the financial instrument is by using a variable number of own equity instrument, it is similar to using own shares as currency to settle, and in substance it is a financial liability. Such a contract does not evidence a residual interest in the entity's net asset, because the other party, the counterparty, is not exposed to the same risk which an equity holder would be exposed to, and therefore the holder of the instrument is not exposed to the ownership risk. Okay, now we'll start some problems. So first you close your book on the screen. Check whether this contract will be a financial liability or not. X Limited writes an option under which the counterparty can force the entity to sell equity shares in the listed company Y Limited for rupees 5 per share at any time in the next 90 days. Yes or no? X Limited writes an option under which the counterparty can force the entity to sell equity share. It means it's a call option. It's a call option because you are the writer of an option and the counterparty has the right to sell. No. Right. Yes, you have to sell him. We have to call option. Okay, don't get violent. Wait. If X Limited writes an option under which the counterparty can force the entity to sell, so we will have to sell. So it's a call option. You are right. Equity share in the listed company Y Limited for rupees 5 per share at any time in the next 90 days. So in call option, who is exposed to the risk? Writer. Who receives the premium? The writer receives the premium. So X Limited is a writer. So they might have received some premium against writing this option. So tell me, can X Limited call it as a financial liability? Yes. Yes. Or you've read the answer and then said yes. So X Limited has a contractual obligation to exchange equity share in another company for cash at ₹5 per share on a potentially unfavorable terms, because the other party has got a 90 days window. So the moment he finds it becomes favorable to him, he will exercise this option. If the holder exercises the option because the market price per share exceeds the exercise price of 5 per share at the end of 90-day period, since X Limited stands to lose if the option is exercised. The exchange is a potentially unfavorable and the option becomes a derivative financial liability from the time the company becomes a party to the option contract. In option contract, I will give you a simple trick. The holder is always at an advantageous position and the writer is always at a disadvantageous position. Because once the parties have paid the premium and received the premium, now who is only going to suffer loss in future? The writer. Is it right? The holder is not going to suffer any more loss beyond the premium paid. Okay, one more question. Try this one. X Limited issued debenture amounting to ₹10 lakh. As per the terms of the debenture issue, it has been agreed to issue equity share amounting to ₹15 lakh to redeem this debenture at the end of third year. No interest will be paid here. Are these debenture financial liabilities? Okay, but how many equity share will be issued? Equivalent to 15 lakh. I think we discussed this example. Amount is only different. Equity share to be issued is of ₹15 lakh. But how many equity share will be issued is variable. It is simply like this. You have borrowed 10 lakh and you have to pay 15 lakh. Since you don't have cash to pay, you are going to settle by issuing your own equity share as a currency only. So if the market price of the share is 10,000 rupees, you will issue, say for example, 150 share. If market price is 100 rupees, you will issue 1500 shares. So the number of equity share to be issued is variable, not fixed. It would vary depending upon the market price of the share. So the equity settled debenture will be treated as a financial liability. Have you written the answer? Okay, right. So I'll just read out quickly. Number of equity share to be issued is not fixed. Number of equity share to be issued is not fixed. Full stop. It would vary depending upon the market price of share. It would vary depending upon the market price of share at the time of share issue. At the time of share issue. It would vary depending upon the market price of the share at the time of share issue. So the equity settled debentures are treated as financial liabilities. Equity settled debentures are treated as financial liabilities. One should also know how to present the answer in the exam. Only writing no is not enough or yes is not enough. Try this one also. Is the answer printed? No. Good. Try yourself. X Limited issued 1 lakh zero coupon bond of ₹10 each. 1 lakh. 1 lakh into 10 amounting to ₹10 lakh. Debenture will be redeemed at the end of third year or bond, issuing 1,45,000 own equity share of rupees 10 each of the company. The question is not same. It is now saying they are going to issue 1,45,000 own equity share of rupees 10 each. So number of equity share to be issued is fixed. Cash received is also fixed. 10 lakh you have received and 1,45,000 shares you are going to issue. So the other party, that is the holder of that zero coupon bond, is exposed to the ownership risk. How is exposed to the ownership risk? Because if the price of this share suppose rises to 100 rupees, he will get 10 times benefit. If it falls to 2 rupees, he would suffer the loss also. So how the equity settled debenture to be classified? Sir, should the equity settled debenture be classified as an equity transaction or a financial liability? This time it is equity. Okay. So write down the answer. This time, in this case, both fixed test. Fixed test means fixed number of share against fixed amount of cash. That is called fixed test. And no obligation test. No obligation test means no obligation to pay any cash. If these two conditions are satisfied, fixed for fixed and no obligation test, then the instrument will be classified as equity. So I will read the answer. In this case, both fixed test and no obligation test are satisfied. In this case, both fixed test and no obligation test are satisfied. Therefore, the underlying instrument is classified as equity. Therefore, the underlying instrument is classified as equity. The difference between, one more line you can add in the answer. The difference between the issue price and redemption value of debenture. The difference between issue price and the redemption value of debenture, that is rupees 4,50,000. How this 4,50,000 has come? You are going to issue 1,45,000 share into 10. 14,50,000 you are going to issue shares in your books, but you have received 10 lakh rupees. So how this liability will be cancelled? Liability account debit 10 lakh, retained earning account debit 4,50,000 to equity share capital account 14,50,000. So the difference between issue price and redemption value of debenture, because you have classified the instrument as equity, you can't call it as an interest now. You have to call it as a dividend. And if you call it as a dividend, then the presentation requirement is it will be shown as a deduction from retained earning, not in the profit and loss. Rupees 4,50,000 is treated as dividend and adjusted against retained earning. This problem will come again at the end of this chapter. Presentation in the profit and loss statement. Okay. So now the summary of our financial liability. Financial liability can be contractual obligation. If it is contractual obligation, there is an obligation to deliver cash or another financial asset, or a contractual obligation to exchange financial asset or financial liability under potentially unfavorable condition. Or it can be contract which will be settled in entity's own equity instrument, which may be a derivative contract or which may be a non-derivative contract. So we have taken example of each of them. Now what are the examples of financial liabilities? Trade payable, okay, bills payable, loan taken from another entity, issued bonds and other debt instrument issued by the entity, derivative financial liability, obligation to deliver own share, just write here obligation to deliver variable number of, to make the statement correct, variable number of own shares worth a fixed amount of cash, obligation to deliver variable number of own shares, variable number of own shares worth a fixed amount of cash, and the last is some derivatives on own equity. Now what is equity? Our topic started from definition of financial instrument. Financial asset for one enterprise, financial liability and equity or equity for other enterprise. What is equity? Equity instrument is any contract that evidences a residual interest in the asset of the entity after deducting all of its liabilities. So basically this holder of this instrument is exposed to ownership risk. Out of the total assets of the entity, first they will be used to pay the liabilities, and if something remains, that is what belongs to the holder of this instrument, and this instrument will be called equity. Is it right? So if you have stake only in the residual net asset, then that instrument is equity and the holder is equity holder. Okay, holder of equity instrument. The presentation by the issuer of a financial instrument or its component part as equity or liability is determined based on the principle of classification contained in this standard. Now, in this chapter, there is a concept called Puttable financial instrument. We will not go into too much of detail of this instrument, but there is one important point about this. Although it has got features of liability, but the standard specifically requires, subject to lot of terms condition which I have not written, as equity. So it may have features of financial liability, but the standard requires that it should be presented as equity. So this is an exception. So puttable instrument is a financial instrument that gives the holder the right to put the instrument back to the issuer for cash or another financial asset. Puttable bond. Have you heard puttable bond? A Limited has issued a bond to B Limited. So it is like a financial liability. What is the power of B Limited, right of B Limited? He can surrender the bond before maturity to A and ask for redemption. So it is an instrument that gives the holder of the instrument, who is the holder? B Limited, the right to put the instrument back to the issuer for cash or another financial asset. So really speaking, this is a financial liability because then you have an obligation to pay cash from A's point of view. But the standard gives some exemptions, or you can say exception. This will be treated as a equity or is automatically put back to the issuer on the occurrence of an uncertain event. Or the instrument may be such that if some uncertain event occurs, suppose Rahul Gandhi becomes Prime Minister, the instrument will automatically be redeemed. Puttable instrument. Is it right? Or on the death or retirement of the instrument holder. So this instrument will be redeemed either at the option of the holder, on the happening of an uncertain event, or on the death of the instrument holder or retirement of the holder. As an exception, please underline, puttable instruments are classified as equity instrument. And there are many terms condition given in the standard which you will read as homework. Okay. Then it is an equity instrument, even though it meets the definition of a financial liability. Now we'll come to our main task today, what is the principle of equity and liability classification. Okay, when is a financial instrument liquid equity and when it is a liability? The standard says focus on substance, not on the form. Okay, in the form they may look like equity, like preference share, but in substance they may be liability. Reverse also, in form they look like bond, but in substance they may be equity. Example we have solved today. Zero coupon bond of 10 lakh rupees was issued. Looks like debenture, bond, liability. Redeemed in the form of 1,45,000 equity share of rupees 10 each. So you have written in your own handwriting, it is an equity instrument. So form is bond, substance is equity. Okay. Preference share as per the law is a share capital. But this standard will say no, it's a liability. You have an obligation to pay cash in the form of dividend and then redemption. Okay. The appropriate classification as a financial liability, equity, or a combination of both is determined by the entity when the financial instrument is initially recognized. So tomorrow you will become CA and then you have issued some instrument. So day one only you have to decide what is that instrument, equity, liability, or combination, means some portion is equity and some liability, like a compound instrument, convertible debenture. The classification is usually not changed unless the terms of the instrument change. So normally we will not change the classification from liability to equity or equity to liability. Of course, if the terms of the instrument itself undergoes a change in such a manner, then we will have to. In addition, when the specific requirement for puttable instrument and instrument that contain an obligation to deliver a pro rata share of net asset at liquidation no longer apply or start to apply, reclassification may be appropriate. This exception will come every time. Exception on puttable instrument and exception on instrument which require the entity to deliver pro rata share of net asset at the time of liquidation. Two exceptions will be there. They look like liability, but the standard says you treat them like equity. One is puttable instrument, second instrument which give rise to a right to claim pro rata share in the net asset on liquidation. What about consolidated financial statement? Now in consolidated financial statement, there is one more interesting thing. At individual entity level, the classification can be different. But at group level, the classification can change. So when you are preparing the consolidated financial statement, what you'll do? From the group perspective, what is the nature of that instrument you have to see. And when you are preparing individual company's financial statement, you have to look at from individual entities point of view. For example, a subsidiary has issued a financial instrument. Example is printed in your note. And subsidiary showing equity, it is equity in the individual financial statement. But what happens when we prepare the group financial statement? It is observed that one of the group entity has given a guarantee to make payment to the holder of the instrument. Okay, so maybe subsidiary has issued equity, but parent gives a commitment, we will pay you a certain amount of cash. So there is an obligation to pay cash at the group entity level. Standard says at group entity level, it will become a financial liability. So in CFS, the classification can change. Now I'm going to give you a simple test to identify a financial liability. And if it is not a financial liability, then it is an equity. First of all, it should be a financial instrument. Okay. Then next task is whether within that is it a financial liability or equity. So what is a simple test? This is a very simple test. Is there a contractual obligation to deliver cash or another financial asset? For most of the simple questions, this test will be sufficient. Check the contractual obligation to deliver cash or another financial asset. If the answer is yes, there is a contractual obligation to deliver cash or another financial asset. And other definition continues, a contractual right to exchange financial asset or financial liability under unfavorable condition. Those are normally not asked in the usual question. Usual question will have this test, whether there is a contractual right to or obligation to deliver cash or other financial asset. If the answer is yes, it's a financial liability. The existence of a contractual obligation of one party to deliver cash or financial asset to another party or to exchange financial asset or liability under conditions that are potentially unfavorable. It will be a liability. And what about equity? In case of an equity instrument, the right to receive cash in the form of dividend or other distribution is at the issuer's discretion. Underline. The moment the discretion is with the entity, the reporting entity, it is an equity, because then the entity will exercise its discretion and not pay. Exercise its discretion and not pay. Then it will be equity. But entity has no discretion. Then it becomes a liability. And therefore there is no obligation to deliver cash or another financial asset to the holder of the instrument. So how do I identify equity? There is no obligation to deliver cash. There is no obligation to deliver financial asset. The discretion to pay interest, discretion to pay dividend, the discretion to redeem is with the entity. Then it is a equity. Is it right? Suppose question will come, I will just discuss right now. Preference share issued by the entity, but the dividend will be paid at the discretion of the entity. Equity. So preference share can be equity. Is it right? Preference share issued by the company. Dividend is mandatory, redemption is at the discretion of the entity. Now it is a compound instrument, because the dividend which is mandatory means you don't have discretion for that. So that is liability. Present value of that amount will calculate and present it as a liability, and the remaining portion will be treated as equity. Or the company says preference dividend will be paid only when equity dividend will be paid. Equity or liability? Preference share. Equity, because company can always not pay the equity dividend and company can avoid paying the preference dividend also. Okay. So now we'll take a small 5 minutes break.